Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your rates rundown for July 31st, 2026. So, despite the fact that the Fed elected to hold rates unchanged for the fifth consecutive meeting, the bleeding in mortgages continued this week. At the risk of sounding like a broken record, for the second week in a row, mortgage rates hit their new 1 year high, and 10-year Treasury yields are sitting at the worst levels since January of 2025. Looking at our benchmarks, 10-year Treasury yields are higher this week by 6 basis points to 4.73%, and the 30-year fixed mortgage rate is worse by about 5 basis points, now sitting at 6.95%. Some of this week's trade was about Iran and oil prices as usual, but the Fed was really the main event. So the FOMC released their latest rate decision on Wednesday, and that decision was to keep the pause in place. No change to rates and virtually no change to the language in the announcement. Now, this was the most likely scenario, so that's not the significant part of what happened. The significant parts had to do with the differing opinions expressed by committee members and the tone set by Chair Warsh in his comments. Those parts have proven painful for interest rates, have investors kind of questioning how serious this Fed is in tackling inflation, and have us closing the week at our worst levels in, well, quite a long time. Let's start with the differing opinions part. Three members dissented with the decision, and while it's not uncommon to have dissenting opinions, this time it wasn't about tone or word usage. All three members favored an immediate 25 basis point hike given the current inflation situation and ongoing inflationary pressures. Interestingly, these views were not inconsistent with the thoughts that Kevin Warsh put out in his post announcement press conference. Warsh struck a tone that was very hawkish on inflation. He talked about the fact that inflation is too high, that it's been too high for too long, that 2% is a hard and fast goal that needs to be reached. And that's kind of where markets began to shift. Interest rates, specifically on the long end, like 10-year treasuries and mortgages, began to rise as investors started to question whether doing nothing was actually the most prudent decision. If we all agree that inflation is a serious issue, that issue, whether you want to call it persistent or not out loud, has been here for 5+ years now. It's getting worse recently, not better. You're adamant that you have no tolerance for anything above 2%. And now you've got a significant contingent of folks saying that something needs to be done and done soon, then why not hike a little bit right now? Unpacking that question is really what's at the root of the aftermath we continue to deal with now 2.5 days on, or 2 days on. Perhaps Kevin Warsh is all bark and no bite. Maybe, despite taking a hardline position against inflation, through their words, this Fed maybe doesn't actually have the appetite to raise rates. And if that's the case, can they be counted on to get it under control in the end? If a stitch in time saves 9, then pushing long-term rates up to year-plus highs is kind of the market's way of preparing for the potential need for 9 in the near future. Where does that leave us? Well, now we've got an extended stretch until the next Fed meeting, which doesn't happen until mid-September. Right now, there's a 2 in 3 chance that they'll actually go through with a hike next time, but those odds are sure to change as the unpacking of the Fed's messaging and strategy continues. We're going to get employment data next week, which is super important, always important given the fact that it's the other leg of the Fed's dual mandate. The Hormuz still is closed, and the next round of inflation data is going to come with oil prices back into their 80s and 90s, not in the 60s and 70s like they were. So expect rates to remain volatile as they have been, but this time we could probably expect them to stick closer to the higher end of the range than the lower end of the range. If we get another month of decent inflation data, or if the Iran situation improves, then mortgage rates could get back into mid-6 area, but that's probably not the most likely scenario. If the environment remains consistent, Kevin Warsh will either have to raise rates in September or risk losing credibility entirely, and that would be bad news for rates. That's all I got for you this week, folks. Have a great weekend, and we'll see you next time.